Hi, and welcome to the Stockscores Market Minutes for October 26, 2015. This week, my topic is the stock market cannot be predicted. Now, as a trader, I'm making predictions all the time. I'm not saying that you can't consistently make money by making your predictions about the market. But what we have to recognize is that any prediction we make about stocks or markets is really just a guess. It's not like saying, if I put a glass of water outside when the temperature outside is below freezing, that water will turn to ice. That is a prediction that has 100% certainty because we know that water freezes below zero. Well, below 0 Celsius, below 32 degrees Fahrenheit. So the point of this is that every trader is going to be wrong some of the time. And it's really this uncertainty is how we make money as traders. If the market was certain, if we knew where things were going to go, well, then there'd be no risk, and therefore there would be no room for profit, or at least market-beating profit. What's important is when we enter a trade, we need to establish the point where the market proves our guess wrong. So if you're buying a stock, you should go into that saying, well, I'm betting or I'm guessing that the market is going to move up from here, but if it goes below this price level, then the market will have proved me wrong. Now, that price level shouldn't be some arbitrary number. It should be based on some analysis that determines that your analysis of the entry point is wrong. We have to recognize that trading perfectly is impossible, and so we need to stop trying to do so. We need to stop trying to buy at the best price and sell at the high. Instead, we just want to be consistent. We want to make predictions that, while not right all of the time, over a large number of trades, we make money. So here's an example. I bought the VXX today at the green arrow. This is a 2-minute chart of the ETF VXX. I was making a prediction that the break from a flag pattern, given that the market was really overbought, the SP 500 was overbought, I thought that the market will pull back, and I looked for my entry signal, found it at the green arrow. That was my prediction. At the time, I said to myself, well, it falls below 1820. I'm going to say I'm wrong and get out. And then I ultimately sold at the red arrow. Why? Because it was a break of an upward trend line. My prediction, based on my analytical method, was to say that the market was likely to go lower. But notice that for the next half an hour, that prediction was actually wrong. But I don't care. I made profit on the trade. It was a prediction that turned out to be mostly correct. And eventually the market did roll over and did go lower, but for a short while after I exited that trade, I could have had remorse. I could have said, oh, I should have stuck with it. Look, it went even higher still. Well, that's not the point of trading. The point of trading is about being consistent. All right, let's get into this week's analysis. It was a real important week, I would say. The market looked like it was going to roll over and move lower on Wednesday after some, I would say, somewhat negative earnings numbers came out. And then Thursday, the European Union, Mario Draghi came out and said, hey, we're going to stimulate the economy if we need to. Well, that stimulus, that desire by central banks to either print money or keep interest rates low or do whatever they have to do to stimulate their economy, that's what's driven the bull market since it began in 2009. And as luck would have it, those comments reversed the negative signal that happened on Wednesday, and the market went higher. Now, I predicted on Wednesday that the market was going to go lower. I was proven wrong. My prediction was proven wrong Thursday morning. I don't care. I'm wrong part of the time. I just got to move on and go with what the market is telling me. And at that point, the market was telling me that it wanted to go higher. Now, again, it gapped up on Friday. Market got a little overbought. My prediction then was that it would pull back. It did pull back for about an hour and a half, 2 hours, and then it went higher again. So the point in this chart is that there's always these gyrations, and you can trade in and out of these ETFs on those gyrations. Here's the S&P 500 on a longer-term weekly chart. You can see a good week there. We have broken the pullback. It looks to me like we're going to move up toward the highs, which I have drawn in with a red line there. And that's where the market will find resistance. It'll be tough for the market to break through that, but it looks like we could have one more good solid week. Now, if next week the market goes up to, let's say, 210 on the SPY and then starts to weaken and go down, we run the risk of building that falling top that I've talked about for a couple of months. So we're still not out of the woods in terms of this potential reversal of the long-term upward trend, because we could still build a falling top, which would mean lower prices ahead. We see no signs of that yet. I just want to make you aware that you want to keep an eye out for that potential falling top pattern. All right, here's the IWM, which is a small cap index, and typical of the bull market that we've had since 2009, the small cap stocks have not participated in the way that the large cap stocks have. You'll notice the S&P 500 moving up, testing the highs. The small caps really did very little this week. Why? Because when it comes to monetary stimulus from central banks, the money goes to the large caps. These hedge fund managers are happy to borrow cheap money and buy large caps that pay dividends that are lower risk because they get leverage from these incredibly low interest rates, and that's where the action is. And we started to see a little bit of a comeback in the small caps a couple of weeks ago as people said, well, you know what, US interest rates maybe are going to start to go up, and so we have to play some risk now. We have to buy things that aren't in the Dow 30 or the S&P 500. But with Mario Draghi's comments this week, that has gone back to the way it's been for a number of years, and now we see the small caps again underperforming. It doesn't mean they can't play a little catch up. Eventually they will catch up, but right now they're still below their downward trend line. Chart of the TSX 60, it participated in the rally finally at the end of the week there, breaking that downward sloping flag, or maybe a little bit of a downward sloping channel pattern. You can see the gap up through resistance, at some resistance on the intraday chart. But really where it gets interesting is when you look at the weekly chart of the TSX 60 ETF. You can see that downward trend line was broken. That's a pretty good signal that the TSX wants to go higher. Now, the problem I have with that prediction is that the commodity stocks, which I'll show you in a moment, are still going to suffer because of strength in the US dollar. So I think it could be the TSX 60 goes up, but we may not get all of the TSX 60 participating. It could only be that the banks or the companies outside of the commodity sectors do well. So we want to keep an eye on how this performs, but certainly a good sign from the TSX that it's going to finally end its multi-month slide lower. The TSX Venture, starting to build an ascending triangle pattern, not a bad pattern. I wouldn't say it's great, but given how bad the TSX Venture has been, it's pretty good. It's a step in the right direction. I think it's still going to take some time for this market to turn around, but hope is not lost on it. So this is kind of a confusing chart. This is the TLT, which is U.S. Treasury's 20-year Treasury bond fund. So back in late July, early August, the Treasuries broke their downward trend line. That meant Treasuries were likely to go higher, interest rates lower. And then they pulled back, and they've been sort of gyrating in this little pennant pattern. So I've got a whole bunch of lines drawn on this chart because what's important to notice right now is that the volatility in the bond, in the Treasury bonds, has really compressed. See how we're at the pointy end of the triangle? So we're eventually going to get a breakout from this pattern. Will it be up or down? I would say it slightly favors an upside breakout, but it's far from certain. It's a confusing pattern right now. If we break up, that means bond prices are going up, interest rates are going down. That would imply that the U.S. Federal Reserve isn't going to raise rates this year. Perhaps it's going to be some time before they raise rates. So this is a real critical chart to watch, even though it's quite a boring chart right now. You want to keep an eye on this one because when the bond market finally starts to move, it's really going to telegraph what the world thinks about U.S. interest rates. UUP, the U.S. dollar, broke its downward trend line this week, and this is one of the critical charts this week, that U.S. dollar breaking that downward trend line on Mario Draghi's comments. Of course, if Europe prints more money, stimulates the economy over there, then what happens is their currency falls, U.S. dollar strengthens, and that hurts commodity prices. And so gold pulled back a little bit this week, still stuck in that downward sloping bearish channel right at the top of it where we would expect it to get resistance. But certainly this week's performance shows us that gold still hasn't broken out of that negative pattern. Oil also down this week, not a lot, still within that rising bottom pattern. And so there is still potential for oil to turn around, but it's right at support. So next week is important. Does it hold that green line that I've drawn, or do we get a move down through that line for the week, which would imply we could retest the lows on oil? So I want you to be cautious with commodities because of that strength in the US dollar. Now, big move on the US dollar this week could mean a little pullback next week, could mean a little pull up on gold and oil, but still that doesn't mean looking out 2, 3, 4 weeks we don't have to be cautious about the commodities because of that strong signal of the US dollar breaking its downward trend line. Finally, fear didn't really go down, or volatility, the VXX, didn't really go down as much as the market went up, and that's largely because the VIX has kind of gone back into its normal range. Even though the chart doesn't show it so much here, you got to remember that these ETFs, or this is actually an ETN, gets rebalanced based on the futures market, so you can't really trust long-term support and resistance on this chart because it's an ETF or ETN. You have to really look at the VIX itself, and even that is somewhat difficult to do. So my point, though, is that volatility still has showing that there's some concern about the market, even though stocks really had a strong week. Fear didn't drop off the face of the earth, so we still want to be cautious with stocks. And that really is the tone of my comments. You know, European stimulus broke the market out of its indecisiveness, and it sent stocks and the US dollar higher. That hurt commodities, not a lot, but it did hurt it. And it continues the Fed-inspired desire to own large cap stocks. We saw the money coming into those large caps, not so much the small caps. We are short-term overbought, big move over the last couple of days, but there's really no sign of weakness. I think we could still move all the way up and retest the highs from early August. U.S. markets should retest those highs, but you want to watch for that falling top, because if we get a falling top on the weekly, start to roll over, then we could be in for more volatility. Given the time of year, probably not going to happen. So neutral long-term on U.S. stocks, bullish short-term, although, again, a little overbought, so we could see a pullback short-term. Canadian stocks, neutral long-term, but at least we've broken the downward trend line, just we're still stuck in that sideways range. Gold, bearish long-term because we're in that downward channel. Neutral short-term, right at some resistance, so we could go either way. And oil neutral on both time frames. Well, that has been the Stockscores Market Minutes for October, 26th, 2015. Have a great week in the market and trade well.